You've probably heard that investing is this super complicated thing, right? Something just for the experts on Wall Street. But what if that's not actually true? What if the whole thing is way, way simpler than you've been led to believe? Okay, but let's be real for a second. It doesn't feel simple, does it? If you've ever looked at the world of finance and your brain just kind of went into overload, well, you are definitely not alone. It's a super common feeling. So why? Why does it feel so complicated? I think a huge part of the problem is the image we all have in our heads. You know, from the movies, we expect this total chaos, right? Complicated charts, flashing screens, people yelling into phones. But the reality for most of us these days, it's just using a simple app on your phone. Seriously, if you can order a pizza, you have the skills to start investing. And that anxiety a lot of us feel, it usually comes down to four main things. I call them the four fear factors. First, there's the jargon overload, all those confusing words. Then there's the very real fear of losing money you worked hard for. You've also got to navigate a world full of fake gurus and scams. And on top of all that, it just feels like there's no clear roadmap for how to start. And you know what? Those are all totally valid concerns. So let's just cut through all that noise and get right down to the simple truth. At its absolute core, investing is just this. It's making your money work for you instead of you always having to work for it. That's it. That is the whole game. And this brings up a really important point, the difference between saving and investing. They're not the same thing. Saving is about putting money aside. It's safe, and you absolutely need to do it for emergencies. But investing, that's about putting your money to work. Yeah, there's some risk involved, but the entire goal is to make it grow over time. And why is that growth so important? Well, it's because of this thing I call this silent enemy. Inflation. It's the reason a coffee that used to cost $1 a few years ago now costs $4 or $5. If your money is just sitting in a savings account, it's actually losing its buying power every single year. So how do we fight back against that silent enemy and actually build some wealth? Well, this is where the magic happens. The answer is compounding, what some people call the magic ingredient. It's this amazing idea where your investment earnings start making their own earnings. It's like a tiny snowball that, as it rolls, just gets bigger and bigger and bigger all by itself. Just take a look at this. Say you start with $1,000. For the first few years, it grows a little. After 10 years, it's looking pretty good. But then look what happens. At 20 years, it's more than doubled. And at 30 years, wow, the growth goes almost vertical. It's exponential. This shows you the single most important rule of the game. Time is your greatest asset. Okay, so if time is our superpower, what are the actual tools we can use? This is where people get intimidated, but you don't need to be an expert. You really only need to understand three core building blocks. That's it. First up, we've got stocks. The simplest way to think about a stock is that you're buying a tiny, tiny little piece of a company you already know, like Apple or Amazon. When that company does well, the value of your tiny little piece can go up. Next, and this one is really, really key for beginners, are ETFs. That stands for Exchange Traded Fund. Now, think of an ETF like a shopping basket. Instead of buying just one single company, you're buying a basket that holds tiny pieces of hundreds of different companies, all at once. This gives you instant diversification, which is just a fancy way of saying you're spreading out your risk. And they're super easy to buy and sell. And the third building block is bonds. This one's pretty straightforward. When you buy a bond, you're basically giving a loan to a government or a big corporation. In return for your loan, they promise to pay you back with regular interest payments. Because of that, they're generally considered a safer, more stable type of investment. So for most people who are just starting out, ETFs are an excellent place to begin. You get that instant diversification, which is a lot less risky than trying to bet everything on a single company. Plus, they're usually low cost, and honestly, they're just really simple to understand. All right, so we've covered the what and the why. Now, let's get to the how. Let's break down how to actually get started with a super simple 4-step plan. First things first, what do you actually need? I promise, it's not a finance degree or some secret password. It's stuff you probably already have. A phone or a laptop, an internet connection, an account with a trusted investing platform, and a small amount of money to start with. And I mean small. You can literally start with what you'd spend on a few coffees. So here are the steps. 1. Set a goal and make sure you're thinking in years, not days. 2. Choose a platform. Find a user-friendly app that you like. 3. Start small. Just get comfortable with the process. And 4, this is the most important one, invest regularly. Consistency is way more powerful than starting with a big amount. And that strategy of investing regularly, it actually has a name: dollar cost averaging. It just means you invest a fixed amount of money on a regular schedule, say $50 every other Friday. This strategy takes all the stress out of trying to time the market. Sometimes you buy when prices are high, sometimes you buy when they're low, and over time it just averages out. No guesswork needed. This brings us to our final and maybe most important section. The tools and the plan are pretty straightforward, but long-term success in this game really comes down to having the right mindset. See, the biggest hurdles for new investors usually aren't financial, they're emotional. So here are the classic traps you want to avoid. Putting all your money into just one stock, checking your portfolio every 5 minutes, selling in a panic just because the market dips, thinking this is some get-rich-quick scheme, and of course, blindly copying what some influencer tells you to do online. Instead, you want to cultivate this mindset for success. Realize that discipline is way more important than talent. Learn to ignore all the daily noise from the news. Understand that real wealth is built by being consistent over a long time. It's about shifting your goal from getting rich to simply staying invested. I absolutely love this quote because it nails the idea perfectly. Successful, long-term investing, well, it should feel a little boring. If what you're doing feels like an exciting trip to the casino, you are probably doing it wrong. So if you remember just one thing, let it be this. Investing isn't some kind of magic trick, it's just a combination of two simple things: basic math, the power of compounding, and human patience over a long, long time. So let's bring it all home. Forget about trying to become an expert overnight. That's not the goal. The goal is simply to start. So I'll leave you with this question. What is the first, small, manageable step you can take today just to begin your learning journey? Thanks for joining me.